Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week, I'm delighted to welcome a new guest to the podcast in the shape of Ashley Thomas, who recently joined Winterflood Securities as their renewables infrastructure analyst after many years of experience in and around the sector and the industries he's covering. So welcome, Ashley. I'm going to kick off by talking about, if we may, some significant news in the renewable energy space this week, which was the announcement of the results of the latest auction of offshore wind, announced by Ed Miliband, the Climate Secretary. Now, he came out and said this was a great success. He said it proves that what he's after, his net zero plan, is up and running still, and it's going to bring down energy bills for good. So just to go through the details of that first then. So the outcome of the auction is that they've had offers on 8.4 gigawatts of offshore wind in the auction, but most of that has come from a single company, which is RWE. And the strike price, or the proposed CFD price, is at £90.9 per megawatt hour. Is that right?
Yeah, that's correct, Jonathan. Great to speak with you today. Yes, so we've had the results of the auction round 7 for offshore wind. Onshore wind and solar will follow at a later date. And in total, as you mentioned, the government has procured 8.4 gigawatts of capacity, within which 8.2 gigawatts for fixed offshore wind, a small amount for floating offshore wind. And you mentioned that a large element of that capacity has been secured by the German utility RWE. So in total, there were 4 projects for fixed offshore wind for that 8.2 gigawatts. RWE secured 3 of those 4 projects. So 3 gigawatts Dogger Bank South off the coast of Whitby, 3.1 gigawatts Norfolk Vanguard, and 0.8 gigawatts Awel Imor off the Welsh coast. And then SSE secured 1.4 gigawatts for the first phase of the 4 gigawatt Berwick Bank project in Scotland. So in total, in terms of the capacity, the government is broadly on track for its 2030 clean power targets for offshore wind. And actually in this auction procured more than was expected. So about 8 gigawatts was procured. The market and the industry had been expecting only around 5 gigawatts would be procured because the budget initially was set at around 900 million per annum once these projects were fully built. And Ed Miliband, the Secretary of State, chose to increase roughly double that annual budget to 1.8 billion to procure that additional capacity.
Right. So what do we make of all this? He says it's a great success. You say it's more than people had expected. And I guess compared to the 5th auction round when no offers were made at all, that was a lower price. And the 6th round, which did get some offers, but one of which has since been cancelled, he's increased the budget. So how does that sit with the general perception of how this industry is developing?
So to procure the additional capacity, the strike price, the £91 per megawatt hour, the inflation-linked fixed revenue that the wind farms will receive over the next 20 years, that strike price has increased. Like for like, it's increased by about 20% compared to AR6, the previous auction. In terms of comparisons, is that good value for money? It's £91. It's more than onshore wind or solar, which would be about £60 per megawatt hour. But obviously, there are land constraints with onshore wind and solar, and it's a more intermittent technology. It's a bit more expensive than the wholesale power price, which at the moment is about £75 per megawatt hour. But I think the more valid comparison, given this is capacity that's coming on at the end of this decade and will then last for the next 30 years, is what would be the cost of building new generation capacity that could deliver largely baseload generation And the comparison that the Secretary of State made was the cost of new build gas-fired power plants, which if it was running at a lower 30% load factor, which would be nearly £150 per megawatt hour, or the cost of new nuclear. And if we look at Hinkley Point, the CFD strike price inflated up to today's money would be about £130 per megawatt hour. So that's the consumer benefit that the government is highlighting. I guess the other consumer benefit is what happens to bills in procuring that additional capacity. And RWE and one of RWE's co-investors, Masdar, commissioned a report before the auction using Aurora and Baringa. And both of those reports determined that paying up to £94 per megawatt hour would produce a consumer benefit, i.e. power prices as a result of that additional capacity would fall and produce a consumer saving of a greater amount than the cost of the subsidy. So, the £91 being below that 94 comparison suggests that this is a good deal for consumers. It should produce lower power prices in the future, and we can perhaps touch on that in a bit in terms of the potential impact on the investment trusts.
Yeah, well, that's the interesting part, of course. There is some controversy around all these claims. In reality, what he's done is it's inflation linked for 20 years at this price. We don't know what's going to happen to power prices over the next 20 years. We can guess, we can estimate. But would you generally agree yourself as an analyst that within the assumptions that he's made, this actually will work out to be a good deal for consumers in the end?
I think over the medium term, and the judgment that had been made was power prices in 2035. So the majority of the capacity will come on between 2030 and 2032. So it is across the medium term. And, I guess with the CFD structure, consumers will only be paying when the wind farms are generating. So although there's an element of increased bill because the transmission capacity has to be built in advance, in terms of the output, consumers will only be paying at a time when the wind farms have been constructed and are operating.
And just in terms of, we mentioned RWE being the predominant bidder in this auction, and we know that earlier auctions failed, or at least one of them failed because the price was too low for people to meet. But what's happening to the offshore wind industry generally? We know that Ørsted, for example, has been having issues. We have projects have been cancelled. What is the background to that? And perhaps I could say, why have not more people come in for this auction at this price if it actually is a decent price for the generators?
So unlike some technologies such as solar or even batteries, where we've seen technological advances have driven down the cost of the units, for offshore wind, we have seen cost inflation, the cost of the turbines themselves, the cost of installation, but also the cost of financing these projects, given interest rates have risen. So, I think it's understandable that the strike prices have had to increase over the last few auction rounds to actually get these projects to be developed. In terms of why some projects have struggled, so if 8 gigawatts was secured in this auction, it's estimated that around 20 gigawatts bid in. So if there wasn't a budgetary constraint and if it was decided that the UK government had wanted to procure more than 8 gigawatts, it would have been possible to have procured more, albeit potentially at a higher price, because the raw projects that were unsuccessful in the auction, and presumably a number of those projects will bid into next year's AR8 project. In terms of why some projects have been successful and others haven't, obviously the successful bidders, RWE and SSE, are very well established, well resourced, international multi-utilities with strong balance sheets. And actually a number of the projects, certainly for a number of the RWE projects, have been projects that they have been working on for some time. So in terms of the lease costs and certain other elements of the projects, they may have secured those earlier at a time when the costs were lower.
Okay, so let's come back then to the investment trust sector. We have a number of trusts that are involved in renewable energy, as we know, not just in offshore wind, but other sources as well. And also we have battery storage and things like energy efficiency and so on. But the sector has not been performing well. The discounts have continued to widen, and last year renewable energy produced a negative return for shareholders. So in the context of that, obviously, it's not been a particularly happy backcloth. What does this auction result, if anything, tell us about the health of the investment trust sector to the extent that they're involved in offshore wind?
Well, I think there's certainly a direct impact in terms of medium-term forecast power prices. So having procured more capacity than expected in this auction, there is potentially more capacity in the consultants' longer-term power models, and that could result in a lower forecast power price. And on our estimates, the additional 3 gigawatts that have been procured in AR7 against expectations could result in about a 3% lower medium term, i.e. 2035, power price than would have been expected had the government just procured the 5 gigawatts. And for the likes of pure UK renewable operators such as Greencoat UK Wind, that 3% lower long-term power price forecast could have about a 4% reduction in their NAV potentially. So for renewable operators, it's potentially a marginal drag given it could lead to lower long-term power prices. There is a flip side for battery operators, because if we have a greater than expected amount of intermittent, more volatile renewable capacity, the spread in power prices, the volatility of power prices is likely to be higher, and therefore the revenue opportunity for battery assets would be higher. And similarly, we estimate that a 3 gigawatt additional wind capacity should increase battery asset revenues by about 1.5%. So both of these are more marginal effects, but effectively it's a marginal negative drag for existing renewable operators and a marginal positive for battery operators.
The other thing that's been hanging over the sector, at least more recently, well, there's a couple of things we can talk about. First of all, the relationship with gilt yields. There has been pretty close, but the renewables, last year they saw their discounts widen on average, I think it's fair to say, despite the fact that yields have actually been moving in a more favourable direction. Government gilt yields, that is. In terms of the outlook for interest rates, what really matters, I guess, to the renewable trusts are medium-term gilt yields rather than short-term gilt yields. And the longer-dated gilt yields are still higher than they were, whereas short-dated ones are coming down. So in terms of interest rate sensitivity, how do you see the outlook for the sector in that context, looking ahead from where we are at the moment?
You're right that it's longer term risk-free rates, and given a number of these trusts also have inflation linkage, it's more what happens to real yields rather than nominal yields. And yes, we haven't really at this stage seen a material movement down in a longer term, be they 10 or 30 year real gilt yields. On discount rates, I think we have a split in the market in that even if the risk-free rate doesn't move, we have had transactional evidence within the infrastructure sector, i.e. infrastructure assets being sold at values in line with or at a material premium to carrying values that support the current discount rates for the infrastructure investment trusts, be they 3i Infrastructure or HICL or TRIG. So even if risk-free rates have moved up a little bit or haven't come down, those investment trusts can point to market evidence to suggest that the discount rates they're using to calculate their NAVs appear appropriate because comparable assets or even their own assets are being sold at NAV valuations or material premiums. That's different for renewable investment trusts, where the M&A market has been far more challenging. both the number of transactions and the pricing, and where we've seen a number of the renewable investment trusts find their own disposal program more challenging, be it Aquila European Renewables or Next Energy Solar in Australia, or even Bluefield Solar Income Fund, where its initial sale process was aborted. And when I look at the discount rates for the renewable investment trusts that typically are around 8%, I can look at comparable investment opportunities in the UK, be it regulated gas networks, where Ofgem, the regulator back in December, gave a price control that effectively offered 8.1% nominal allowed equity returns, which to me suggests that an 8% discount rate, levered discount rate for renewable investment trusts potentially appears low if I could get a higher allowed return from a purely regulated gas network that also has its asset base indexed to inflation. So, yeah, I think if risk-free rates remain at their current level, then I think there is upward pressure on the discount rates used for renewable investment trusts, because comparable investments offer higher returns and they haven't got that market evidence of being able to dispose of assets in line with NAV. Whereas I think the situation for investment trusts is more supportive given that market evidence of transactions.
Right. I should make the point that obviously the higher the discount rate adopted, that reduces the NAV and vice versa. And as you say, what you really need to look at also is a kind of levered discount rate. So you have to add on the degree of gearing that these trusts have, right? So in some of these cases, they're 40, 50%. And that's become an issue for some of the renewable trusts because they're coming up against those limits. That's why they're under pressure to sell assets if they have to, because otherwise they're going to go over their self-imposed ceilings on what their debt capacity should be. Is that right?
Yeah, effectively, the original business model is now broken, because if the original business model was, the companies trade at a premium to NAV, we issue equity to buy assets or projects that are NAV accretive, we experience NAV growth that supports that premium to NAV, and we continue to issue equity and acquire assets. Now that the trusts, both the infrastructure investment trusts, but particularly the renewable infrastructure trusts that are trading at near 40% NAV discounts, now that that NAV discount appears effectively structural, the opportunity to issue equity is now forgone, and the companies have largely used up their debt capacity. So as you mentioned, gearing is typically 40% of the gross asset value. A number of the investment trusts are up against their ceiling gearing levels, and therefore there isn't the opportunity to either acquire or develop assets that may be NAV accretive. And therefore, as an investment trust, you're much more exposed to the macro NAV drivers, be they what's happening to interest rates and discount rates, which have generally been negative drivers to date, or what's happening to long-term power prices or generation expectations, which again have been a negative drag for NAV valuations.
So in a way, they're sort of stuck, aren't they? They're a bit becalmed, and they do have this other issue, which is when you're basing your NAV on a forward projected series of cash flows, they are also facing what's called the subsidy cliff edge, which is that at some point, some of these projects they have will no longer receive subsidies. The subsidies will expire. And unless they can replace them, they're basically going to be facing a tougher future. So 2 questions I have arising from that. Number 1 is, what can they do to get out of this hole? And number 2 is, does it make sense, and this is perhaps a slightly more radical suggestion, for them to remain as investment trusts? Because if they were operating companies, for example, they could go to their shareholders and say, we do see growth potential and we'd like to do a rights issue or something, or we'd like to issue some shares which are at a discount, which is something that conventionally investment trusts aren't able to do. And I think we had a sort of example with that in a way with Bluefield Solar, right? When they went to their shareholders and said, would you like us to cut the dividend and invest a bit more or carry on reducing debt? And the shareholders said, no, we don't really want that. We want you to repay debt as an absolute priority. So what is the solution for these trusts that are, for the moment at least, stuck where they are?
Yeah, I think it's right that business as usual, given the model has broken for a number of the investment trusts, business as usual can't continue over the medium term. And if the longer term cash flow profile is one of a decline and potentially a subsidy cliff edge in the 2030s, then the dividend policy potentially has to be reviewed at some point, and even the general strategy. So what should the investment trusts and the boards do and have been doing? There has been a reassessment of the strategy. As you mentioned, Bluefield Solar, given it has quite a material development pipeline that it can't at the moment afford to progress, and it has around 400 megawatts of solar CFD contracts already secured and is bidding for a further 300 megawatts. Bluefield Solar considered pivoting to a growth strategy to develop out that pipeline, but to finance that would have required a material reduction in its dividend. I would estimate a reduction of over 50%. But that growth pivot could potentially have been value accretive. But the presentation of that strategy came without extensive shareholder consultation. And also the current shareholder base for a number of these investment trusts, particularly those with high dividend yields, has historically been income focused. And therefore, were these trusts to seek to make a pivot towards more of a growth profile, then potentially that shareholder base might have to go through a period of transition. That could potentially be an organic development. We could also see M&A both within the investment trusts, so consolidation, either consolidation on a similar technology basis. So we have 3 UK solar funds that were we to see consolidation, there could be both economies of scale, greater liquidity, potentially a reduction in investment fees, potentially a reduction in operating asset costs. But there could also be consolidation cross technology. And actually there is potentially merit in combining, say, a wind and a solar portfolio, because you would reduce the volatility of generation. 2025 saw very strong solar irradiation and solar generation, but relatively weak wind generation. And therefore, by having a more diversified portfolio, you reduce that generation and cash flow volatility and could potentially justify a lower discount rate and therefore a higher NAV valuation. So we could see consolidation within the investment trust universe. And then, as you mentioned, we could also see companies potentially exit the sector, either to move to an operating model or potentially, as we have seen, as a result of acquisition, to have other parties, be they private equity or industry based, seek to grow out that development pipeline or run the operating assets.
You are listening to our Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. On that subject of consolidation, we did have something which turned out to be not very well received. That was a merger proposal between HICL and TRIG. Now, that wasn't obviously a renewable combination because it was a combination of economic infrastructure and renewable energy, and that wasn't at all well received by the market. So do you think that was a false step, and that doesn't particularly offer any clues as to the other kind of consolidation that you've just been talking about?
Yes, I think the fact that the HICL-TRIG merger proposal wasn't successful isn't necessarily an indication that consolidation in the sector won't work. I think the particular issue in that situation, yes, it would have provided increased scale, greater liquidity, a larger vehicle for investors to invest in. But it did involve taking HICL, an investment trust that historically had focused on core economic infrastructure without any renewable exposure, and combining it with the renewable infrastructure group, TRIG, with its renewable exposure that HICL shareholders either may have proactively sought to avoid or hadn't necessarily wished to include. And in addition to that structural combination of a core economic with a renewable operator, in the deal mechanics, there was also potentially a transfer of value from HICL shareholders to TRIG shareholders. So I can understand why there was investor resistance. I think HICL standalone is very attractive, has a solid standalone growth strategy, could organically move up the infrastructure spectrum to higher return sectors, be it waste to energy or district heating, and doesn't necessarily need to seek to acquire a pure renewable operator. And following that deal having been halted, I would expect TRIG to still seek to participate in sector consolidation, albeit clearly not with HICL.
Just going back briefly to Bluefield Solar, I mean, that's one of, I think, 3 trusts which are right up against their gearing ceilings, the others being UK Wind and Octopus Renewables. Following that failed, if you like, pivot, are they effectively up for sale? What do you think is actually the most likely outcome for them from this point?
So they are undertaking a formal sales process at the moment. I think a sale is the most likely. As mentioned earlier, they have got quite a material development pipeline that includes projects that have secured CFD contracts. And recently we've seen a number of other solar developers with CFD contracts progress and make final investment decisions on those projects. So I think there is value to be achieved by developing out that pipeline. And therefore it could be a private equity partner or a utility that in the end seeks to acquire Bluefield Solar.
But is the implication of what you were saying earlier that if you are a shareholder in that particular trust, which is trading at a near 40% discount or something like that, that you're not going to get NAV in any deal, that no buyer is going to come in and pay full NAV for that particular trust? Because from what you were saying earlier, that probably isn't where the market is at the moment.
Yeah, were a deal to be finalised, I'm not expecting it to be at NAV. While Bluefield Solar does have value within its development pipeline, I see the valuation of the operating assets within the NAV calculations as potentially being too high, and also higher carrying values than other investment trusts carry comparable assets at. And in part, that comes down to the power price forecast used. As mentioned earlier, I expect for, say, Aurora, which has the highest power price forecast within those used by the investment trusts, I would have thought that post this recent auction, there could be another reduction in power price forecasts. And some investment trusts, such as GCP Infrastructure Income, actually use quite conservative power price forecasts. And that means that the carrying value of their renewable, be it wind or solar assets within their NAV calculation is materially lower because they're using this materially lower power price forecast.
Okay. So we've talked a lot about the wind operators in particular and the solar operators, but there are other elements of the renewable energy sector that we all follow. And there, I think the prospects are often different for different reasons. They have different exposures. So a couple of names that I kind of picked out because they're different, if you like, not exposed to the same risks as the two. Well, one of them is the Battery Storage Trust. They obviously had a very bad experience, so they now seem to be recovering. For example, Gresham House Energy Storage has been a good performer over the last year, a very strong performer, having performed very badly before that. So I'm interested in your views about the outlook for battery storage. And then there's something like the Forsyth Environmental Infrastructure Trust, which doesn't have the same exposures as the likes of Bluefield and Greencoat UK Wind. Can you tell us just your thoughts about those two, the battery storage sector outlook, and finally the other Forsyth investment trust I just mentioned?
Well, on battery storage, it's a subsector that we like, in particular the GB market. It's an element of the power market that needs more capacity, particularly as we continue to add intermittent renewable capacity. And within the two remaining battery storage funds, Gresham House Energy Storage and Gore Street. Obviously, we have had one of the funds, Harmony Energy, be acquired last year, so there are only two remaining at this stage. Within the two remaining, we have a preference for Gresham House Energy Storage. It's a more focused portfolio, so it's UK only. It has a focused growth strategy. It has a 3-year plan that it's executing well on, and that 3-year plan involves effectively doubling its capacity, certainly in terms of duration of its batteries. And it has put in place both the financing and largely the development pipeline to execute on that doubling over a 3-year period. So Gresham House performed well last year, albeit from a weak period in 2024 when market revenues declined materially. We still see it being attractive. Post that 3-year plan and having built out that planned capacity, we see it generating materially higher free cash flow, and the current valuation would effectively be a 13% free cash flow yield, which we view as attractive. And we also, as an asset, given this increasing renewable capacity, we view the battery sector as one that the larger utilities could well seek to acquire to gain a presence. Because unlike wind or even solar, with the exception of EDF, the large utilities that operate in the UK haven't really got a material battery presence, which would be very beneficial for them given their diverse generation mix and given their large trading activities. So yes, we certainly see batteries as a subsector as attractive, and particularly within that, Gresham House Energy Storage.
But of course, you no longer get a dividend from that one. They've cut the dividend. Presumably, therefore, you would expect the shareholder base that came in because of the dividends and so on no longer there. They've exited. So this is basically now a growth opportunity rather than a yield opportunity.
But actually, Jonathan, that capital allocation decision demonstrates the potential benefits. We spoke earlier that a number of the solar funds and the broader renewable sector may have unsustainable dividend policies. By recognising that there was shareholder value to be achieved by investing in new assets or augmenting existing assets to increase their duration, by deciding to reduce the dividend payments during that investment phase, has actually produced material shareholder benefit, certainly in terms of the share price reaction, but also in terms of NAV accretion. And I think that was the right strategy to undertake. So yes, the initial reaction with the reduced dividend may have caused some displeasure, but with the benefit of hindsight, I think fundamentally was the right thing to do. And for shareholders that retained their exposure over that period, they have seen very strong share price performance and good NAV growth.
Yes, indeed, up 65% or something over the year. Okay, and then finally on that Forsyth Trust that I mentioned, the Forsyth Environmental Infrastructure, what do they do? What's distinctive about them?
Well, I think it's a diversified portfolio. So, we spoke earlier that a number of the monoline renewable investment trusts are struggling, and in part There are issues with the volatility of both generation and cash flow, and that certainly for the wind operators, sort of impacted their cash flows during 2025. Fundamentally, Foresight Environmental is a far more diversified portfolio, and I think that diversification is a strength. Less than half of the group is exposed to the power sector, and within that, only around a quarter of revenues are exposed to merchant power prices. And it therefore has a more diverse business mix that includes wind and solar, but also other generation assets such as anaerobic digestion plants that for Foresight Environmental largely produce green gas, not power. And as we move forward, we have largely decarbonised the power sector, but it's more challenging to decarbonise the gas sector, and they provide a solution for that. But also biomass power generation assets, and both the anaerobic digestion plants and the biomass plants are held at a value that is materially less than the replacement cost of those assets, and could well see an extension in their asset lives. So for the anaerobic digestion plants, the current expected life is only 20 years, which is the subsidy period. Technically, they could operate for far longer, and it could well be that either the government brings in subsidies to support those plants, or the market creates revenues to support those plants over a longer time. And then in addition to those broad energy generation plants, Foresight Environmental also invests in other environmental assets, be they low carbon transport, so bio-CNG, so low carbon refueling stations for heavy trucks that would provide the solution for the supermarkets to be able to deliver produce at a time when actually it's very difficult for EV heavy trucks to make economic sense, as well as other assets within the controlled environment sector, including aquaculture in Norway. So we see it as a diverse portfolio, producing stable, diverse cash flows, with a number of growth assets that represent about 18% of the portfolio that are now starting to be operationally ramped up, producing strong NAV growth, that don't currently produce or contribute to the group's dividend cover, which also then means we spoke earlier about potential subsidy cliff edges. Because Foresight Environmental has this more diverse portfolio and has a greater degree of growth assets, it hasn't got the same degree of subsidy cliff edge or revenue decline that other funds may experience in the 2030s. So yes, it's another fund that we believe is attractive. And actually, it's only Foresight Environmental and Gresham House Energy Storage that we favour within the renewable energy space. Our other stocks that we favour typically tend to be infrastructure funds such as 3i Infrastructure, HICL or Cordiant.
And of course, just on the Foresight Trust, we mentioned environmental infrastructure that is currently on a yield of around 11%, I think, and a 33% discount. And that dividend is actually covered. So that's an interesting combination compared to some of the others. Well, Ashley, thank you very much for coming on the podcast and talking in depth about these things, particularly about the renewables. We might come back and talk about the more general infrastructure trusts again in the near future, because I think they are interesting. But in the meantime, the renewables are sitting there. As you say, the original model is broken. And as yet, there's no real clear shining light at the end of the tunnel, if you like. But it may become clearer as the year goes by, as we see either consolidation or others coming in or changing the structure or whatever. So it could be a year of significant activity, even if it's not particularly promising in the very short term. Would that be fair sort of summary?
Yes, I think effectively the business models will be reconsidered, and I think that will prompt a change in strategies, potentially dividend policy, and potentially ownership structure.
So worth watching the space. Very good. So that brings us to the end of this particular podcast. My thanks to Ashley Thomas, who is the Renewables Infrastructure Analyst at Winterflood Securities.
Thanks very much, Jonathan.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.